I would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to Thursday, August 11th, 2016. Thank you for making the show a part of your day. I really do appreciate it. And sometimes it stuns me. I guess it's appropriate now to also give a shout out to some of my listeners. I've been catching up with some messages that folks have been sending me over the last couple of days, and I love that some of the most commented things are the fact that I play Overwatch with my kids, and that I may be too much of a sharer. Or actually, no. You know what? That makes it sound like you guys were saying, "Dude, shut up! Stop sharing the personal stuff." I that's my mental attitude. Is kind of, Robert, shut yourself up. You're oversharing. I really appreciate the feedback I get when I do that. I've never had anyone call me out on that as something that they think is bad. It's usually an appreciative, hey, I feel your pain, or what you. I had one person tell me that they thought that what I said resonated with them personally. So good, and I try to extrapolate a more general thing from a specific personal thing from me, because all of us are different, right? I can't expect that whatever personal thing that had an effect on me is going to, even if you go through the exact same thing, there's no guarantee it's going to have the same effect on you, right? So I think what I try to do is point out the scale of what the event in my life, and I'm probably one of those weird people that puts a whole lot more emphasis on. Well, okay, we'd be getting back into those personal weeds again. But anyway, it really depends on what's the most important things in your life, right? So I hope it helps, and I don't know. Maybe some of the follow-up ways we manage these things are more generally applicable than the specifics of what got us there. But frankly, the people who have seemed to be the happiest, because here's the other truth, right? We spend a lot of time talking about investment and in real estate, and the reason I'm here is because I like it. I like it, and I dislike the high level of dishonesty that exists in this business. And you know what? To be fair, I'll bet it exists everywhere. I'll bet guys that work for IBM, Apple, Cisco, Bank of America, I bet every single person in any of these businesses gets upset about dishonesty that exists for whatever reason, right? Because the reality is it's not a real estate problem. It's a people thing. There are just people out there who, whether they just never thought it through enough to realize what they're doing is dishonest, or just are okay with it. They've fallen into a habit or been taught a habit that works, because we've discussed that on this show. I've never told you that doing real estate the way I suggest, if you're someone who does real estate, I know I have a ton of licensed real estate agents who listen to the show. I've never told you that the way I suggest you should do business is the more profitable way. I know tons of extremely financially successful real estate agents that do it the way I think sucks. I talk to them all the time. So yeah, right? And that's we all have to make our way through life deciding whether or not that's okay or whether it's not okay. And what level of not okay we're willing to put up with before we actually say something. Me, I guess I'm a whiner. Which explains why I whine into a microphone for 30 minutes every day about stuff that annoys me. But then, of course, also lots of just general news things where I comment. So, but anyway, I was just feeling very thankful and appreciative of my audience because, I swear, I can't even think of the last really annoying interaction I had with somebody based on a disagreement. Even when folks contact me and we disagree, you guys are fantastic. That's the bottom line. Thank you very much. Not just for listening to the show, but for being such awesome feedback people in terms of having a constructive conversation back and forth with me. I really appreciate that. Okay. Today is kind of an odd show because it's likely to be a little bit patchwork. I've got a couple of articles that I think fit in with things we've talked about recently, particularly the fact we spent a pretty good chunk of time talking about Houston yesterday. Very interesting data relating to Houston coming out today. I'm not sure how I feel about Houston. I get this feeling Houston's kind of at the top end of where it is. I don't necessarily mean that that's a bad thing. It may be a situation where it goes flat from here on out, which would still represent, I think, a decent investment for someone if they're buying right. But we got some data today that might fit in with you if you're a Houston interested person. But we also have another little tidbit that I actually am not going to say necessarily take my advice on. Because this is a little bit more out there. It's a little bit more general economics, right? Stuff that would absolutely leave a huge crater right over our heads in everything. So on this one, it's not, I'm talking about something that's very real estate specific and y'all should be really up to date on it and concerned about it. I'm saying, regardless of what you do in life, whether you are a ditch digger or a nuclear physicist, this is a big thing. And I'm trying to think through, let's pretend some big, ugly economic thing happens. And it really depends on the nature of it. I've always kind of wondered if the value of our dollar drops dramatically, right? We've talked about this before. The invisible tax of inflation. Which, again, here I go to the weeds. I made the mistake of buying a mocha in a Barnes & Noble the other day. And somehow this has got to have something to do with real estate. I'll figure out a way before I'm done. So I do and it becomes automatic, right? You're not even really thinking about it, particularly when you're standing in a Barnes & Noble, because there's nothing more awesome than having thousands of books around you, because I like books. They're one of my favorite things. Another topic we could talk about. So I'm just doing my thing. I buy my mocha, and I realize after I've purchased it, I just paid $4.84 for a freaking medium-sized mocha. And some part of my brain went, no, no more, never again. And of course, when you're inside of a Barnes & Noble buying from a Starbucks, it's more expensive than a normal Starbucks. But then I realized, well, wait a minute. The last time I bought a mocha from a normal Starbucks, it was like $4.60 or something in that neighborhood. And the last time I actually consciously in my head recalled what I paid for a Starbucks mocha, it was like $3.60. So, I mean, a whole dollar had kind of gotten heaped on top of it. And I look at this cup of dark brown fluid, which does have chocolate in it. So it's hard to put a price on the yumminess of chocolate. But I thought to myself, how in the hell am I nearly paying $5 for this? And it reminded me of the whole inflation thing. And so, and I'm not sure where else that goes. This was really just a segue into inflation. But I'm kind of concerned about things in a general sense. Now, we've talked about how I sort of track international bank things as it relates to us, or how it could influence our economy. And this is a sincere call out to all of you, because I know I have some people in my audience that are ridiculously knowledgeable bank type folks. I know I've got a listener in England who is a pretty high ranking dude in the Bank of England. I know I've got a lender guy in Atlanta who also takes interest in banking stuff. So because you folks have reached out to me. So I know you guys are out there. So I wanted to throw this out, and I wanted to get opinions on what this does to us, because I think it's a big deal. Now, it's from The Street, so it's a respected publication, right, that kind of keeps track of this kind of stuff. And the headline is this: Deutsche Bank to initiate the next financial crisis? Stock could be headed to zero. And then the little subtitle here is, if you thought Lehman Brothers was bad, you should watch Deutsche Bank. There are similarities that will scare you. And remember, Lehman Brothers is one of the things that's seen as one of the big crazy things from the real estate situation because of the bundling of subprime mortgages and all that other kind of stuff. And as I start to look more into this stuff, the things that are crazy, there's several crazy things. And I want to throw them out there. And I'm not necessarily concluding this with here's what you should do because of this information. I'm actually kind of concluding it with, what do you think about this? So and Deutsche Bank is absolutely ridiculously important. Don't think just because it sounds like it's in another language that it's not important to the American economy. It's gigantic. First of all, is a thing that I only became aware of within about the last 6 months, and realized that from a financial standpoint, from a banking standpoint, it was a scary word, and that word is derivatives. But the other thing is also how liquid some of these banks are, which they need to be a certain amount liquid in order to deal with potential demands for funds, right? So I've been trying to kind of figure out what all this stuff means, because Deutsche Bank, which is gigantic, has a lot of these risk factors built into it that if things can even go a little bit wrong, things could be super bad. On June 29th, the IMF stated that among the globally systematically important banks, Deutsche Bank appears to be the most important net contributor to systemic risks, followed by HSBC and Credit Suisse. And that's according to the Wall Street Journal. Now, the article goes on to say, quote, even if true, why should you be concerned about a German bank and how it will affect you while living in the United States? The IMF adds, quote, in particular, Germany, France, the UK, and the US have the highest degree of outward spillovers as measured by the average percentage of capital loss of other banking systems due to banking sector shock in the source country. That's according to Bloomberg. Deutsche Bank is inseparably connected to tons of important banks around the world, including all of the most important banks in the United States. So Bank of America, Chase, Wells Fargo, huge in terms of their connections, right? Now, they go on to talk about leverage of Lehman versus Deutsche Bank, and we could get into that. But before I did that, I wanted to – one of the big problems with Deutsche Bank, according to what I'm reading here, is how heavy they are into derivatives. So what the hell is a derivative? So I went over to Investopedia to get that definition, and I'll have a link to the full definition in the show notes for this show. And kind of bear with me here. I get this is the driest, most boring crap. But remember, words like subprime and, securitized loans and all this other kind of stuff were foreign words to us before the 2008-2009 downturn. And I can't help but think, because of the similarity of these things, that words like derivatives might be a pretty essential part of our vocabulary in the not-too-distant future. So let's jump in here. The answer to the question, what is a derivative, according to Investopedia, is as follows. A derivative is a contract between two or more parties whose value is based on an agreed-upon underlying financial asset, like a mortgage, index, or security. Common underlying instruments include bonds, commodities, currencies, interest rates, market indexes, and stocks. Futures contracts, forward contracts, options, swaps, and warrants are common derivatives. A futures contract, for example, is a derivative because its value is affected by the performance of the underlying contract. Similarly, a stock option is a derivative because its value is derived from that of the underlying stocks. So it's a speculative thing. And that should scare you a little bit. Moving on and relating to the speculation part of it, speculators seek to profit from changing prices in the underlying asset, index, or security. For example, a trader may attempt to profit from an anticipated drop in an index's price by selling or going short the related futures contract. Derivatives used as a hedge allow the risks associated with the underlying asset's price to be transferred between the parties involved in the contract. Okay, so now remember how when all of this stuff melted down last time relating to subprime lending and also securitized subprime loans, remember how there was an option to be able to invest in betting that those things would go down in value. That is one of the things that can happen here. And what's nuts is how leveraged banks like Deutsche Bank are in derivatives. Huge in derivatives. Another bank that's huge in derivatives, the number one in the U.S., if I'm not mistaken, Chase, as a major instrument of its business for investment. This should scare you. The more I learn about derivatives, the more it makes me think someone came up with a whole new set of vocabulary words to use instead of all the words that now scare the crud out of us because we know how bad they ended up being from the 2008, 2009, 2010 timeframe when all these things dribbled out about what were the underpinnings and what were the major tidal waves that got us into so much trouble. How did so much money get lost so fast? This stuff is what it was. Here's another element that's been concerning me. And remember, this is all stuff I've been reading for a little while, stuff that kind of made my brain hurt a little bit, so I avoided it. I kind of put myself back in the position of thinking this is probably good stuff to know because it just sounds a little bit too familiar. These banks, to be healthy, you can kind of hedge on how much you think is healthy. But banks like Deutsche Bank have less than 3%. So in other words, if they've got $100 a year money, or $100, they're only keeping $3 of it around. They're only keeping about 3% of the total money that they've got control over in cash in the vault somewhere. That's a really low number. Numbers I've heard thrown around that would be more reasonable given what's going on would be 10%. Now, some of you may contact me and argue about that number. Great. But I don't think there could be much disagreement that that's a ridiculously low number, particularly when these guys are so heavily weighted in derivatives. And remember, let's translate that into securitized subprime loans that are bundled together. That would be a freaking derivative, right? We could make a derivative out of that stuff. So this is scary stuff in my thought. Now, maybe not. Maybe this is all very normal and the vast majority of the time everything's wonderful. But this level of speculation concerns me, particularly when it becomes such a major part of what banks are up to. And not just any bank, not like Joe's Bank down at the corner, but major international banks and the biggest American banks. So next you might be saying, hey, Robert, shut up. There's absolutely no reason for you to be worried about derivatives. They're totally normal. They're totally cool. I'm going to take a quick break here. And when we come back, we'll talk about how the good folks at U.S. News don't really think that's the case. So stay right there. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services, right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everybody. We're talking about probably the least sexy thing ever. Just sort of my more recent dipping my toes back into sort of looking at the general lay of the land as it relates to different banks. I was trying to get an idea of if I wanted to do a show on what are the biggest threats to the real estate marketplace that are outside of real estate specific stuff. And banks have always been a little bit problematic in terms of just random articles I've come across that are concerning. But we've been talking about derivatives, and in the last segment we defined what a derivative is. If you've forgotten, I completely understand. I just read it and I've nearly forgotten. But the long and the short of it is, it's like a bundling of stuff that you base a contract on, and you are betting on what the outcome is going to be. And an article that came out from U.S. News a few years back, actually 2012, the headline was, "Derivatives should be banned from financial markets. Derivatives are too risky and could lead to market disaster," which is kind of a worrisome thing. The article starts off by saying the idea that the financial products known as derivatives pose a danger to the financial system is nothing new. Commentators have been pointing this out for years. Most famously, Warren Buffett referred to derivatives as time bombs and financial weapons of mass destruction. Recently, a complex derivatives trade caused over $5 billion in losses at JP Morgan. So it would have been recently in 2012, which obviously was 3 years ago. And here they sort of sum up what a derivative is. Derivatives are bets between two parties that are made today with a payoff in the future based on the value of some stock, bond, or index. One party will profit if the reference security or index goes up in value, and the other party will profit if it goes down. These bets usually settle up every 3 months based on the value at that time, and then a new calculation period begins. There are many variations to this basic pattern, but almost all derivatives involve some form of bet in which gains and losses are calculated and settled up periodically. Myth number one. This is why this was interesting. They kind of had a few interesting things. Derivatives break up risk into parts and allow the pieces to be put into strong hands, best able to absorb losses. And now this is important because what did we just talk about in terms of how much cash on hand some of these banks have? And if they're hugely leveraged by derivatives and they've only got 3% cash around, that could be a problem, right? Does anyone remember one of the reasons why we had such a problem in 1929? So values of stuff went down. We don't need to get into the reasons why the stock market stuff dropped, but there was a drop in the stock market. And at that time, people could buy on margin, meaning they could buy stock. You could buy $100 stock by only putting $10 down. So you'd quote unquote own the stock, and then there'd be this margin thing. Well, unfortunately, when the stock market dropped, and all of these folks who realized suddenly that they didn't have 90% of the originally agreed upon value of the stock, did what was called a margin call. And everybody had to now come up with all of this money. Well, what did all these super smart financial folks do? Well, they didn't take all the money they were making and go ahead and pay off the rest of that margin. They bought more stocks. So they bought more of the things that were now worth less than they were. So even if they sold everything they held, by definition, they'd only be able to pay off a certain amount of the margin call. What was the net result? People jumping out of buildings because they couldn't. They were financially ruined. Okay? So anyway, Derivatives break up risk into parts and allow the pieces to be put into strong hands best able to absorb the losses. And we just kind of talked about how a lot of these institutions, I would argue, are maybe not quite in the position to absorb the losses that a lot of people assume. It goes on to say financial transactions do involve multiple risks. Even a simple loan can have interest rate risk, credit risk, and foreign exchange risk. The original idea behind derivatives was that these risks could be repackaged into separate financial instruments. In the simple loan example, one party could absorb the interest rate risk, another could absorb the credit risk, and still another could absorb the foreign exchange risk. Since each party specialized in a certain kind of risk, it could offer the best prices so that the entire package would be cheaper to the customer than having a single bank absorb all of the risk on its books. The problem with this view is that most derivatives do not derive from an original loan or investment, but are created exclusively to make new bets. Instead of moving risk into strong hands, derivatives actually create risk out of thin air. Risk is not being reduced by derivatives, it's being grown exponentially. Okay. Myth number 2. Derivatives allow, because this is the, if you go and Google this stuff, this is the back and forth you're going to get. And I thought that this article kind of nicely summed it up. Myth number 2, derivatives allow markets to get valuable price information about the underlying security or index on which the derivative is based. I'm not even really sure what the heck that sentence even meant. Derivatives allow markets to get valuable price information about the underlying security. All right, so it's a way to gauge the value of what it's based on, right? This process of getting market information from actual trading is called price discovery. This rationale is heard frequently in the credit default swap market. Credit default swap market. That's the term that we used when we talked about this years ago, where for the folks who bet that these various subprime bundled investment articles would decline in value, right? That was the credit default swap. Basically, bets on whether a company or country will go bankrupt or an instrument, a financial instrument. Supporters say that prices in the credit default swap market provide good information about the financial health of countries in distress, such as Greece or Spain. That's the myth. This explanation ignores the fact that such price information has always been available from the underlying bonds themselves. The market doesn't need credit default swaps to tell it Greece is in trouble. The market in Greek bonds shows directly that prices are falling and borrowing costs are going up and that Greece is in financial distress. There's a third myth here that I don't remember thinking it was super sexy, but let me give you the short version. Bank management has derivatives risks under control using mathematical models that capture the complex interaction of factors embedded in derivatives trades. And I agree with the next sentence. This view is laughable on its face, given the continual series of notorious derivatives fiascos from long-term capital management to AIG to JP Morgan and many others. And this is the kind of thing that annoys me, because this is the experts who wear the expensive suits and wear the ties telling us, don't worry about it. This is above your pay grade. You're not qualified to make these sort of determinations. We have spared no expense in determining the mathematical process that can calculate these models to capture complex interactions. Bull. That is translation for, we really don't know what the hell we're doing. We think we're pretty special, but we're really not as special as we think. Where do you go with that? I mean, obviously they'll put a link to this out there for you to check into yourself. But I think this is risky crap. And when you blend it with the idea that these folks are so undercapitalized, meaning that all their money is out there, quote unquote, working for them, and only 3% of the money that they've got in play is in their hands in cash, is scary. And as a person, now I bank with one of these banks that happens to have tons of derivatives, and it actually makes me worry. I think, how at risk am I if this bank takes a complete nosedive because of how they've leveraged things? Now, what's really scary is the amount of money that's out there in derivatives. We're not talking about a small chunk of cash. In an article from July 2nd, 2015, 5 banks account for 96% of $250 trillion, that's trillion with a T, in outstanding U.S. derivative exposure. Holy free holies. Is that just a crazy number? Specifically, of the $250 trillion in gross notional amount of derivative contracts outstanding, among the top 25 commercial banks, a number that swells to $333 trillion when looking at the top 25 bank holding companies, a mere 5 banks, and really 4, account for 95.9% of all derivative exposure. HSBC replaced Wells as the top 5 bank, which at $3.9 trillion in derivative exposure is a distant place from number 4, Goldman, with $47.7 trillion. The top 4 banks, JPM with $78.1 trillion, Citi with $56 trillion, Bank of America with $53 trillion, and Goldman with $48 trillion. These are all trillions. As historically has been the case, the bulk of consolidated exposure is in interest rate swaps, followed by FX, CDS, and equity and commodity. This scares me. I start reading this stuff, and as I gain more understanding of what they're talking about, I am not comforted. You know how sometimes something sounds scary on first blush, and then when you read more about it and get more information, oh, okay, I get that. No, that isn't what happens. When you first read this, your brain's going to hurt a little bit. Your eyes might roll into the back of your head a little, and there might be a little drool just because of how kind of mind-numbingly oppressive it is. But once you actually grok each little element they're talking about, you're going to start to have nightmares because this stuff is nuts. And again, we're talking trillions, hundreds of trillions of dollars in this whole derivatives exposure thing, and banks that don't have any freaking cash. All their money's in these derivatives. Doesn't that scare you? It should scare you. It scares me. So what happens if this stuff melts down in the same way we had very similar philosophies? I mean, this is almost a cut and paste of what we had go down in subprime lending. And it scares the crap out of me. And these guys have no cash to cover a really bad thing. They've got 3% in cash, and that's it. So there you go. And so where do I go with this? Well, one, holy crap, what do you do? What can you do to protect yourself? Is it a question of having more cash on hand? What is it? What do you need to do to be prepared for this? Next, let's say something like this happens. It could do a lot of nasty things to a lot of different parts of the economy. But I'm guessing it would also potentially cause crazy inflation, because I think as a response to this, interest rates would have to go crazy. They'd have to jump, right? Which would mean that people can't borrow as much money, and all these other things start to get frozen. But that also I think inflation would also be likely. So what does that do to home prices? I mean, in terms of it being a physical thing, if the money is now worth less today than it was yesterday, the theory would be that your property would actually be worth more, right? But remember, we're talking about a marketplace here, and if suddenly interest rates go nuts, fewer people can afford to buy. So as soon as the number of folks who are trying to sell outnumbers the number of people trying to buy, then it doesn't matter that the dollar is now worth less than it was yesterday. What matters now is that no matter what it's worth, people got less of it than they need to buy bread, much less a house. So it seems to me that what we end up with is another ridiculous crash in just about everything. Now, does that make any sense? Anybody else who knows this better, let me know, man. Share some links, because I felt like for a moment I should be putting on my tinfoil hat. That's how out of whack this stuff sounded, and I thought these guys must be nuts. These must be some sort of crazy fringe financial speculator guys talking about this stuff who just want to really get clicks by talking about crazy stuff. No. The more I look into this, the scarier it is. So So there you go. I have nothing to offer you in terms of, hey, this is what you should do about this. I'm actively looking for more information on this. I am actively trying to suss out a logical projection of where does this lead us. And how does it affect us in terms of the assets that we hold, and what does it do to us as buyers, sellers, and investors in real estate? What does it do to the real estate we own? Where does it leave us? So I'm interested in finding that out. Some other stuff I wanted to cover, which I mentioned earlier, a lot less nightmare fuel-ish. Houston home sales dropped for first time in 6 months. Still being described as healthy overall, but I thought this was an interesting number to share. Because why? What did we talk about Houston being the number one location for? The number of rental units being built, the number of apartments. If you look at that map I linked to yesterday in that article, there's a ton of stuff getting built in Houston. Well, that's interesting, right? So it gives people a affordable option to not buy. And by the end of the year, they're supposed to have this record number of units getting built. So I think that's kind of interesting. Now, this report found that 7,204 homes sold in July compared to 7,898 a year earlier, representing a drop of 8.8%. And that's a year-to-year drop. That's not one of those goofy that last month it did this month it did that. This is same month last year. And that's the kind of comparison you want to use when you really want to try to get some sort of an intelligent insight into what's going on in a market, because you're talking about longer trends and you're talking about where things are going more generally. The drop, according to the article, though, is correlated to a monthly analysis. Looking at the data on a yearly basis paints a better picture and instead shows that home sales are up about 1% compared to this point in 2015. So what they may be saying is when you look at it from a quarterly basis, things aren't quite that bad. However, no matter how you want to look at it, that sure does smell like a slowdown to me. And we talked about this yesterday a little bit. So for those of you who might potentially be interested in this as a marketplace, just keep that in mind. Maybe it means that as an investor, you're giving yourself a little bit more of a buffer. Maybe you're anticipating potential flattening, and maybe you're not projecting as much growth as you thought might potentially be part of that marketplace. The other thing I wanted to cover today before we call it quits is that Fannie Mae, Freddie Mac set new all-time low mortgage modification interest rates. Now, this is going to be aimed directly at the listeners who already have a Fannie or Freddie Mac loan and are in a position where they could do a modification to it. The benchmark rate now more than a full percentage lower than it was in 2012. Beginning on August 12th, 2016, so tomorrow, Fannie Mae and Freddie Mac will lower the standard modification interest rate from 3.62% to 3.5%. For the last 3 months, Fannie and Freddie's standard modification interest rate was 3.625, which itself was the lowest level ever until now. So this is something I wanted to point out, because if you can take advantage of it, I think locking in lower rates is a smart thing, particularly for those of you who plan on staying in your home longer. I'm not sure what the cost is involved in doing this, so you're going to want to do the math, more than just the math on this is how it affects my monthly payment. You also want to do the math on, is there a fee for me to do this? I'm not sure that there is. This particular article did not mention it. But as I said, it takes effect August 12th. Consult if you're getting a statement, a monthly statement for your payment. I'm sure there's going to be a phone number on there. Give them a call and see if there is a modification plan. This modification program is going to work for you. Quote, according to the GSEs, the standard modification program is designed to help those borrowers who are ineligible for the Home Affordable Modification Program. That's HAMP, to those of you who aren't familiar. And if you are a HAMP borrower, the new rate does not apply to you. If you're a HAMP borrower, you can't take advantage of this. But feel free to check into it. If Fannie or Freddie hold your loan, this is a great way for you to go and find out if you can't make yourself a little bit more happy in terms of your cash flow on a month-to-month basis. All right, folks. As always, absolutely appreciate you making the show a part of your daily routine. If you'd like to head on over to iTunes or wherever else you use, whatever you use to consume the show, giving it a review or a thumbs up, some stars would be fantastic. That's how the show grows. And the more I can grow the show, the more I can start adding on other cool stuff. Like, for instance, if we were to the point now where the show was grown to a certain size, I would have already been able to do the promised video on analyzing the investment tool that I use, the investment analysis tool I use. Still something I plan on doing, but I have to eke out that time to make it happen for you. But with a little bit more, audience and growth in the show, I could absolutely start moving into a position where I make the show what I'm doing every day. And I'd love to be able to expand on what I offer. So I appreciate that. Thanks again for listening, everybody. I'll talk to y'all next time.